as Richard says, I'll touch on some global capital themes, allocations to real estate, how that money is moving, how it's moving across European cities. We'll look at sectors, the economic factors, and just try to give it a bit more flesh around the bones in terms of themes that we're seeing within sectors and how that's going to drive different investment opportunities. So if we look at the big figures globally, last year we actually saw a bit of a dip in investment volumes across the globe from 1.6 to 1.5 trillion, still a big number. But if we look at the three main global regions, we see two different trends. Asia Pac and EMEA dropping. Investment into the US started to pick up last year. So that probably coincides with changes in economic fortunes, economic growth. But will it continue like that? Who knows? The other key trends that we've seen in the last 4 or 5 years are sectoral. So offices have stayed about flat, but you can see the red line there's residential, so quite a move up in terms of investment going into the resi sector. Retail actually started to come back in 2018, but industrial is also the sector that's been moving up. If we look at, we've done an analysis of about 15 select global investors that we know are diversifying globally in terms of sector, in terms of reach, in terms of geography. So if you look at what they held in 2010 compared to 2018, you see the focus is still on offices and then on retail. But if you look at the ones below it, that's where the real momentum is. So that's the rate of growth for each of those sectors. Huge growth into resi, about 160%. Development, even bigger, a much, much bigger number, moving off a low base. Also, I&L, industrial logistics and hotels, pretty strong, whereas offices and retail, less and less spending going into those sectors. And we know these investors are globally diversifying in terms of what they're doing, so that amplifies the trend that we've seen globally. Also in terms of sources of capital, over the next 3-5 years, we see that changing from institutional to private wealth to family wealth. High net worth individuals will have more of an influx on the market. And if we look at that collectively, so global funds under management, all funds, all assets, all types, is about 165 trillion. We know the allocation from the institutions is about 10.4% as of this year, but we don't know what it is for high net worth individuals, private wealth. But if they were to match the allocations from institutions, and that allocation starts to grow, the amount of capital looking at property could hit something like 2.5 trillion by 2020. So that's fresh capital looking at the market. At the minute, there's about 800 billion was raised last year. There's about 370 in dry powder. So that's about 1.3 trillion anyway. So there's still quite a lot more money coming to the market. And if you put that in the context of how much was spent last year, 1.5 trillion, 2.5 trillion is a big number. So it's going to need to diversify and move across markets, move across geographies, move across sectors to try and find opportunities. If we look at European cities, what this shows is just a range of major markets. The yellow bar represents the amount of cross-border capital in those cities. So we already see that Europe is very international in terms of the amount of cross-border capital that goes into locations. I think it's lowest in Stockholm at about 20%, but everywhere else is largely 50, 60, 70%. Warsaw's way up there, so like 95%. If you look at, I know this is difficult to see on this small screen, but if you look at where that capital comes from, again, you see a bit of a mix. The pale blue is EMEA-based investors, dark blue is North America, the mid blue is Asia. So again, I think we're going to see a lot more capital coming from Asia, and we're starting to see it infiltrate a lot of different markets over the last couple of years. And I think that is something that will continue to grow. If we look at the momentum side in terms of investment into markets, so again, these are the major European cities. This shows the vertical is the last 2 years investment volumes relative to the 10-year average. So anything dark blue is beating its 10-year average. So a lot of markets for the activity in the last 2 years is still pretty strong. There's only a few pale blues and only a few yellows. I keep forgetting to add Moscow to the one at the bottom. That is Moscow, the yellow one at the bottom. If you look at the 5-year, less markets seeing momentum. So there's less dark blue markets that are seeing more activity than they have over the last 5 years. Yeah. So it's a reflection of the fact that the market is slowing, but there's still a lot of growth there. So are the markets that have seen the momentum, will they continue to see that momentum? And that's obviously about a range of different factors: the opportunities, economic growth, price of real estate, the economic fundamentals, attractiveness of a city. So if we start and look at Horizontal is what we call COI score, so cities of influence score. So this is the kind of long-term fundamental attractiveness of an individual city to occupiers and to grow the kind of occupational base. So that's the score on that axis. The vertical axis is capital values. So if you were to draw the yellow line across there, anything over to this side below the line is theoretically attractive because it's lower priced than the other markets and it's got that higher kind of long-term fundamental driver. Another way of looking at it is economic growth. Economic growth vertical, cities of influence horizontal. The cities that are seeing high levels of economic growth, again, they'd be more attractive than the ones that are lower growth. So you might not be putting your money in Milan at the minute. If you look at risk and yield spreads, so this is the spread of yields to bonds within each city. And again, you want to hit the markets that are at the top, ideally the ones to this side. So there's a good collection of markets that you could still put your money in. But actually, it's interesting, say Warsaw and Madrid that were at the top of the other economic growth chart are actually flipped round and they're towards the bottom of this one. So how do you balance that out when you're looking at markets as an investor? So this one looks at the office market. It looks at the proportion of availability to absorption in a market. So essentially how many years worth of space is in that market relative to how much is being absorbed. So that's the vertical. The horizontal is just your traditional vacancy rate. So you can see there's a lot of markets that are inside that 8% vacancy rate, which by any stretch of the imagination is a very low vacancy rate. The ones at the top here on the absorption availability part are the ones that will absorb everything that's available in that market much quicker than the others. And availability is the pipeline of space coming on plus what's actually vacant in the market. But again, there's still a large collection of markets that have got really, really very strong fundamentals, and because there's not as much space being built into a lot of markets, that's probably going to protect the rental position for a lot of investment. The challenge is on the demand side, and we'll touch on the economics a bit now. So employment growth is growing, so we're still seeing more people coming into employment, but because unemployment rates are so low in lots of different markets, that rate of growth is diminishing. So the bars represent the growth, the dots represent that rate of growth. And naturally, because we've got declining working populations and labour markets are getting tight, that rate of growth is starting to shrink, and that's going to have an impact on demand. And then you've got that's having an impact, certainly in Europe, on the economic outlook. Put in the context of the global economic outlook, which is cooling, things are starting to taper off a bit. Now, if we touch on Brexit for 1 minute, we don't know what's going to happen. We might find out later today if there's actually any decision or any movement on it. Who knows? So this is the forecast from Oxford Economics in terms of Eurozone growth. This was done last month, and UK growth. So we're still looking at growth in 2019, although I know in the last couple of days that rate of growth continually starts to move downwards. This is based on a 65% probability that there will be a deal. If there isn't a deal, that's probably going to disappear. And those bars will probably be a bit shorter, but they will start coming back. So short term, if there is no deal, expect not much growth, not just in the UK, but in the Eurozone, because we're all interconnected. But hopefully we will have a deal and that will come back, or at least some of that will come back. But overall, the tightness of markets, we still have economic growth. That's the main thing to put forward. We still see office rents moving across the European market, but at different rates in different cities. Right. And if I can try and summarize, don't worry, I'm not going to go into this one in detail. If we put all these cities together and we look at things like liquidity, the cities of influence score, the capital values, yields, yield spreads, what's the economic growth outlook, what's the yield outlook in terms of whether we expect yields to compress, remain stable, or decompress, what's the rent outlook, occupier conditions, do they favour landlords or tenants? Put all that together, you basically want to be in the markets that are more green. So if we do a simple kind of ranking, that's what the markets look like in terms of where you could be parking your money. Yeah. But lots of things can change that. Touch on some sectoral trends. Obviously, big thing about office markets at the minute is the growth of flexible workspace. We have David from WeWork here who's going to tell us all about it. It's a huge evolution in the last 5 years, just an enormous ramp up in terms of the number of flex work operators moving in the market, and the likes of WeWork and IWG in particular have just really, really not so much exploded, but the amount of extra space they've taken on is phenomenal. Apparently, IWG and WeWork were the two biggest global investors of FDI across the world last year. So that tells you how much money they're moving into this little niche sector. But then if we look at it relative to take-up or as a proportion of stock, so Amsterdam and London, through the mix of flex work operators that are in each city, it only takes it to about 5% of stock. So that's not a very big number. So there's still a lot of growth in it. 10% would seem pretty sensible. It might get higher than that. And if you look at all these other cities, they're only at 1-2% of stock is flex work operation. So expect that to really move and have an impact on office markets going forward. Retail and industrial, we know the retail industrial story. Retail has been dropping down in terms of percentage of investment in Europe. Industrial's been moving back up. That figure is just transactions. If you think about all the money that's gone into major development platforms for the industrial logistics market, it would be much, much higher, because billions has been pumped into it. But why is the money being pumped in? We all know that there's strong e-retailing growth in a lot of markets, and that's driving the whole industrial logistics revolution. But if we actually look further forward, the rates of growth of online retail are slowing. So they're not growing as quickly as they were. They're still growing, so their impact is diminishing whilst consumption continues to grow. So if you look at e-rail penetration rates in different countries, the UK market looks like it's pretty much saturated. It's hit its level. And if you actually look what's happening in UK retail, there's a kickback in terms of the growth in showrooming, click and collect, and all of these different factors that are driving consumers back into retail bricks and mortar and not just into logistics. The pale blue bar represents the 2022 forecast for e-retail consumption by country. So there is still some growth there, but you're also seeing very different levels of e-retail penetration, and that's all down to culture, the way we shop, the way we do things differently in different countries. And it doesn't mean that these markets will necessarily get to the level of the UK or the other markets. I think there's always going to be a difference. So don't expect the same rate of growth. But there is growth, and that's going to drive the need for modern industrial logistics space. But as we see more omni-channel operations, which is the way retail and logistics is going, there's going to be an even bigger demand for even more modern logistics space to satisfy that requirement. How do you deliver it? Where's it going to go? Where's it going to be? Trying to put logistics into a city centre is very challenging because the rents aren't high enough. You're not going to get a gross development value to get it anywhere near existing use values. So you've got to start mixing it with other uses and other assets. And city logistics is all about blending with other uses into mixed use alongside retail, alongside other things to get projects to work. Here's some different ideas in terms of reinventing high streets and towns. The one on the left is a guy who's connected to the British royal family who's setting up a pop-up event, which is horse racing. So basically taking over a city street and having a pop-up event for horse racing. So he's looking at it over Sydney Harbour Bridge, Champs-Élysées, Pall Mall in London. I don't think you'll get it down Rochdale High Street, but you might get it across a few other global major cities. It's pop-up retail, but that looks cool, that looks funky and just brings people in. But it's all about a lot more pop-up retail, blending in good F&B, real proper mixed-use planning, bringing in a lot more green space, real nice public realm, gyms, flexible use of space, and even maybe companies like Greggs, who are actually a really strong retailer. I don't think Greggs will work in every high street. I don't think they'll work on the Champs-Élysées, but you never know. And then Resi's the other one. So if we think about urban population growth in countries, that's basically more people in more cities, or more people in maybe less cities. So there's very strong rates of growth, the pale blue bar of residential drivers of growth into cities. But if we look at residential investment today, it's been growing in Europe, but it's still at a very low level. It's highly concentrated in Germany, the UK and the Nordics. So again, there's a big opportunity to see more resi in more markets, but even more resi investment in these markets, because it's going to be a critical factor in driving these mixed-use developments in big cities. Reinventing space in cities. A lot of demand still for big distribution warehouses around the edge. Cross-dock, in particular, looks like a really good bet in terms of the logistics market on the edge of cities, particularly as cities start to not just urbanize, but as we clean up cities, less cars, e-vans, pedestrianising areas. You're going to need cross-dock to facilitate that. dominant shopping centres will still work on the edge, but it's going to be the blend between high street and retail, and then mixing high street retail into pop-up retail, pop-up events, with homes, with offices, to make cities work. And there's still an awful lot of that to happen as cities evolve to be functional places for people who want to live and work in. If we look at investment by sector into these major cities, it's interesting to see just how much the dark blue dominates, which is offices, a little bit of pale blue for retail, but increasingly different levels of yellow, which is the resi sector coming in. So we're seeing a lot more resi investment into certain cities, but not all. So I think we'll expect to see this change in the next 5-10 years. And how does European opportunities look at a global level? Well, interestingly, if you look at European sectors relative to Asia and Americas on a yield spread basis, we actually offer the best spreads to other global destinations, certainly for European logistics, even for European retail and European offices. Yet these all offer better spread opportunities than any other sectors in different global locations. And I think that's going to continue to bring the money into. Spreads are a good end of cycle option, but it's all about mixed use. It's about omni-channel and basically blending all of those different things together to make cities work and to create opportunities. Following major infrastructure, major redevelopment, urban regeneration is going to be a big part of doing that.